on market reaction on the Fed's unexpected decision to uphold the status quo and keep the pedal on its bond buying program. We are joined by Ibrahim Gassambe. He is an equity strategist for Roubini Global Economics. Thank you for joining us, Ibrahim.
Thank you for having me again.
Well, first of all, I want to get your response. Were you also surprised by the Fed's move today?
No, we weren't really. It was a surprise for the overall market, but from RGE perspective, we've been expecting this delayed in Fed tapering till December. That has been our view since late January of this year, and we've maintained it through the May tapering scare. So this actually didn't actually surprise us, but it was a big surprise to markets.
To the markets, yeah.
Most people were pricing in a September tapering, and it didn't happen. The Fed was a lot more dovish.
Okay, so you expect the tapering to happen in December. Do you still expect it to happen in December?
Yes, we do. The Fed is actually more like playing preemptively being a lot more dovish because of the concerns around the financial condition tightening being a threat to growth. So the Fed would like to be a little bit more slower in terms of pulling back liquidity to ensure that the recovery is much more on a better footing. So the Fed is likely to see more data coming into maybe around October, November, before actually taking a tapering decision.
Okay, speaking of October, we might have this big fight over raising the debt ceiling, and there's some concerns. The last time that happened, we saw the U.S.'s credit rating was downgraded. It had a big impact on the markets. So if that does happen in October and we do see this fight, I mean, do you think that's something the Fed was considering in their decision and perhaps said, you know, now is not the right time for us to taper down our program in case the markets and the economy gets roiled by this debt ceiling in October? Do you think that was a consideration?
Yeah, it was indeed a factor in the Fed decision. Ben Bernanke himself, the chairman of the Fed, actually mentioned that as one of the reasons why they're actually taking this preemptive dovishness. So that was part of the Fed decision to wait and see how the market reacts to some of those debt ceiling debates that looks like it's going to be a bit of a mess. But we expect the market to successfully weather that discussion.
All right, Ibrahim. Well, given that there's no decision that's been made or the status quo has been maintained, how should an investor play this right now? Where should they be positioned?
Right. We've been advising investors to switch a little bit from the bond type of the bond proxy in the equity market, i.e. utility sectors. Some of the sectors that really rallied strongly today, the investors should actually take this opportunity as a way to actually unload their position and move into cyclical sectors that are more leveraged to actual economic activities, sectors like industrial, materials. So because liquidity is becoming less of a factor in driving market return going forward and growth the stronger factor, one should be exposed to those sectors, and they're attractively valued right now. The bond-like sectors, the utility, the high yielders, they're already expensive, and the Fed normalization valuation should also normalize. All of these things should be underperforming the growth leverage sector.
Okay, so looking at growth stocks really, or that are connected to the growth of the U.S. economy. But,
exactly.
But where do you see that growth really coming from right now? Because we're seeing, I mean, if we take a look at just earnings, corporate earnings, which we're heading into that season, we see the profits are up nicely, but revenue growth isn't very strong. So that's worrisome, isn't it? I mean, doesn't that tell us something negative about the state of the economy?
Well, yeah, revenue growth haven't been really great, but we do expect some of the forward-leading indicators, things like CapEx plans, expectation, all of those things are turning around. Housing is turning around. Obviously, it's not as strong as we wish for it to be. Confidence is high, but activity level has yet to catch up with the confidence, the increase in home builders' confidence. But we do expect the accumulation between housing, CapEx, companies' CapEx, and maybe a little bit of the retraction from fiscal drag would actually help propel the economy forward. And some of those, this strong growth would leak into EM maybe a little bit down the road.
EM's down the road. Okay, so
right.
Lastly, how should an investor right now play EM equities?
EM remains a bit of a risk primarily because of the tight financial conditions. Even though the Fed was a little bit more dovish today than expected, we still think that the regime has changed. Tighter financial condition is here to stay with EM. What would actually save EM right now would be stronger growth, and we don't see it, at least not in the next 6 months. Perhaps 12 months out or 18 months out, assuming China is a wild card. Assuming that China is fine, then we can have a much more constructive view on EMs.
Okay. And lastly, just want to take your view of Janet Yellen. I mean, it's presumed that she will be confirmed as the new chairperson of the Federal Reserve. Will this have an impact on the markets quickly? Yes or no?
Not really. We don't think so. We don't think that the Fed policy changes under Yellen. It's still more of the same policies. So we don't see any difference in that.
So don't pay too much attention to that.
Not really.
Okay. Thank you so much, Ibrahim. That was Ibrahim Gassambe. He is an equity strategist for Roubini Global Economics.